As per normal distribution, 95% of the time the prices remain inside the Bollinger Bands. Because of this, conventionally, Bollinger Bands are used to identify reversal trade opportunities, as the prices are expected to reverse once it gets close to the bands. However, sometimes the price can actually stay close to, or even outside the bands, for a significant time before finally reversing. During these trendy market phases, the reversal strategy can hit stop loss multiple times and wipe out the small profits made during the sideways market, leading to significant drawdowns. But what if, instead of taking these reversal trades, we start taking few high-quality breakout trades, using Bollinger Bands? These large drawdowns will turn into net profits. In this video, we will quickly discuss the concepts of volatility, Bollinger Bands, and then explore a simple yet powerful Bollinger Bands breakout strategy that has been quite profitable in recent times. By the end of this video, you will be able to take high-quality trades like this. So, make sure to watch the entire video without skipping anything. But before that, please subscribe to the channel for more strategies like this. Let us begin by first understanding the concepts of volatility. In simple terms, volatility can be defined as the speed at which the price moves. If the price takes a long time to cover a certain price distance, with small swings and no real momentum, then the volatility is considered low. This price behavior is referred as sideways or range-bound markets. On the other hand, when the price moves in a quick and rapid manner, creating large price swings and big candles, the volatility is considered high, and such markets are referred as trending markets. This transition from low to high volatility is the golden phase where we can get higher rewards for the risk taken, making it crucial to identify such zones. This is where the Bollinger Bands come into the picture. Bollinger Bands are a technical analysis tool used to assess price volatility and identify potential overbought or oversold conditions. It consists of 3 bands. By default, the middle band is a 20-period simple moving average. The upper and lower bands are 2 times the 20-period standard deviation above and below the moving average. Meaning, as per the concepts of normal distribution, the price has 95% probability of staying within the upper and lower band. The volatility is identified by the relative width of the band. When the band width is low, the volatility is relatively low, and when the band width is higher, the volatility is higher. The overbought and oversold conditions are identified by the relative proximity of the price to the upper and the lower band. When the price is closer to the upper band, it is considered overbought. When the price is closer to the lower band, it is considered oversold. In our strategy, we want to exploit the transition of the market from low to high volatility. So, we will focus on the width of the Bollinger Bands to identify such transitions. During low volatility, we see that the bands become extremely narrow, and the price moves sideways inside them. The price keeps on bouncing from the upper band to the lower band. As you can see, the price stays within the bands most of the time. When the price touches the upper band, it immediately reverses downwards. Similarly, when the price gets close to the lower band, it immediately reverses upwards. During high volatility, the bands go wide, and the price moves extremely close to the upper or lower band. In an up move, the price stays near the upper band for several candles without reversing. Few candles may even close above the bands. Similarly, in a down move, the price stays near the lower band for several candles before reversing. Few candles may even close below the bands. In short, during low volatility or contraction phase of the market, the Bollinger Bands contracts. During high volatility or expansion phase of the market, the Bollinger Bands expands. We will use these expansion and contraction of bands to identify the golden zone where market transitions from the contraction to expansion phase and take high-quality breakout trades in this zone. A breakout is a point where the price breaks out of a sideways market and transitions into a trend. If we can enter at the right moment, we can capture a significant move with a very tight stop loss. So, without wasting any time, let's get to the strategy where we use the Bollinger Bands to help us identify the right time to enter these breakouts. But before that, if you have liked the video so far, please consider giving it a like and subscribe to our channel for more videos like this. Moving on to the strategy, we will follow 3 sets of rules to enter the trade. First, we need to identify sideways market by looking for areas on the chart where the Bollinger Bands are relatively narrow. We should ensure that the prices move sideways during that time, with upper band providing clear resistance for bullish breakout trades and the lower band providing clear support to the price for bearish breakout trades. Further, this sideways behavior or consolidation should be at least 10 candles long. Larger consolidations have higher chances of successful breakouts. Second, we shall identify the take profit zones. These are major support and resistance zones from where the prices may reverse. We must ensure that the potential reward is at least 3 times the risk. If not, skip the trade and look for other opportunities. Breakout trades usually have lower probability but higher reward potential. So, to maximize our profits, we must capture big whenever we win. Next, we wait for the price to break out of the Bollinger Bands and the support or resistance zone. For a bullish breakout, the breakout candle should be a strong bullish candle, closing above the upper band and the resistance zone. Do not trade based on Bollinger Bands alone. The price must also breach the resistance zone. Remember that the price action is the key. Indicators only indicate potential trade opportunities and help us filter out high-quality trades. Enter the trade once the high of the breakout candle is taken. Set your initial stop loss at the nearest swing low. Target a minimum of 3 times the risk. As you can see, this trade was a win. If you are an aggressive trader, you can book half your quantity and trail your stop loss till it is taken. The stop loss can be trailed to the nearest swing low or the middle band. The trailing stop loss can sometimes give jackpot wins like this, and in long run, these occasional large wins can significantly improve your net profits. Let us take a look at another example. Here we have a healthy consolidation. There is no immediate resistance, so there is room for the price to move. We enter our trade when the high of the breakout candle is taken and target a minimum of 1:3 risk reward. As you can see, it is a win. In case if you are wondering, these are 1-hour charts of Bitcoin USD. In the next example, we enter the trade once our requirements are met. A healthy consolidation, no immediate resistance, and a strong breakout. But this time, unfortunately, we hit our stop loss. Do note that stop losses are part of the game. As long as we win big and lose small, we will have positive expectancy and we will profit in the long run. Here I would like to stress the fact that most breakouts fail. This is a well-established fact. Therefore, do not waste your energy trying to improve the win rate of a breakout strategy. Instead, focus on winning big whenever the breakout occurs. In long run, you will end up in net profits. Now let us quickly go through few examples for bearish breakouts. First, look for a Bollinger Band squeeze. Make sure that there is a healthy consolidation, at least 10 candles long. Second, identify the take profit zones and ensure that the next major support zone is farther than 3 times the risk. Third, wait for a strong breakout. The breakout candle should be a strong bearish candle closing below both the lower band and the support level. Enter the trade once the low of the breakout candle is taken. Target at least 3 times the risk. If you want to trade aggressively, book half quantity at 1:3 risk-reward ratio and keep trailing the stop loss until it's taken out. Similarly, in the next example, we enter the trade once all our requirements are met. A healthy consolidation, sufficient room for the price to move, and a strong breakout. Conservative traders close their trades with a regular 3 times profits. But for aggressive traders, this trade turns out to be a jackpot. As discussed before, these occasional large wins can significantly increase the net profits, and sometimes can even be the determining factor which turns a losing or break-even trader into a profitable trader. The inherent nature of markets is such that you cannot win all the time, but you can definitely win big when the market actually moves. So, focus on winning more whenever you win than winning all the time. Once you develop this mindset, there is no stopping you from becoming a profitable trader. If you liked the video or learned something new, please give it a like and subscribe to the channel. It motivates me to create more content for you and also helps other people to find this video. See you in the next video. Till then, happy trading.